Davis with the Lake Champlain Chamber, and I'm glad that you can all join us. It is my pleasure to welcome you to this webinar with People's United Bank and People's United Advisors this afternoon. I'll be introducing our panelists in a moment, and then we'll be diving into the great material that they have for all of us. There is in this webinar a Q&A function, so that if you have questions for our panelists, please feel free to type those questions in using that Q&A function. And once we get to the Q&A portion of the webinar, we'll be pulling questions from there. So without further ado, it's my pleasure to introduce our panelists. We have with us today John Trainer, who is the Chief Investment Officer for People's United, Head of Equity Strategy, John Conlon, and Head of Financial Planning, Susanna Brochu. And I'm hopeful that each of them will share a little bit of their background during their sections of the presentation. But we've got quite a powerhouse of panelists with us, so thank you for taking the time. And with that, I'm going to pull up the presentation and we'll get started. Okay, there we go. Take it away.
All right, great. Well, this is John Trainer, and thank you all for joining us this afternoon. I'm here in sunny Bridgeport, about 300 miles south of you all, and I can tell you I would much rather be in Burlington right now. But let's go through the presentation. If you can go to the first slide, we chose this slide specifically for you all to take a look. Just go to the next slide. We chose this slide to show you all a little bit of the local topography. This is a shot taken from Camel's Hump looking over at Mount Mansfield. And we really think it's a good analogy for what we're going through right now. You know, we were at a peak in the economy back in February. We have gone through a phenomenal decline, a record-setting decline for a number of reasons. But what we're hoping and what we're going to be talking to you about this morning is how do we get back up to a new peak? How do we climb up the next mountain? We've made tremendous progress, but as I'll show you and John and Susanna will show you, we still have a ways to go. So we're making good progress, but we've got a ways to go. If you go to the first slide in the presentation, now I'm a rower, so I get to pick the sport. So I chose rowing, and you know, this is a humorous slide, but it's meant to communicate a very serious topic. You know, throughout, you know, really since for the whole post-World War II period, our global leaders, you know, they had differences, but they all tried to work together. Whether it was trade treaties, defense treaties, different types of global coordination. Let's work together. Let's make the entire world a little bit better. The last several years, we've fallen off. The wheels have come off that bus, and we could have a great conversation just about the topics that we would talk about with just this slide. You know, it's a big issue. As investors, it concerns us because as we bifurcate, as we move apart, country to country, region to region, as investors, that's not a good thing. So one of the concerns that we have going forward is a continuation of this cleaving. We want to see people come back together. We'd like to see some more global solutions to some of our problems come about. So, you know, this, again, it's a humorous slide, but we're trying to communicate some very important issues, you know, as citizens and then also as investors. So this tends to dampen our expectations for economic growth as we go forward over the next several years. If you go to the next couple of slides, what I'd like to do is just show you, and if you've been to any of our economic presentations, I probably had this slide in the packet. If you take a look at it, it's the leading economic index. You know, it's something that's in the Wall Street Journal every month, and you'll see if you take a look at those peaks that you see there. Normally, it gives us a warning about 12 to 18 months before a recession starts. The LEI starts to roll over. It gives us a great warning. Take a look at what happened in February and March of this year. We were actually flirting with new all-time highs, and then the rug was pulled out from under us. There's an expression, the black swan, you know, that type of event that nobody could have seen coming. Well, we have had viruses, we have had pandemics in the past, we've had SARS and Ebola and a few things just in the last few years. The black swan event that we went through was really the complete shutdown of the economy, not just in the US, but on a global basis. We've never done this before. So that really surprised everyone. But if you take a look at those indicators that should have given us a good warning, none of them worked. So the LEI did not work. It is hopefully forecasting that things are getting better. So hopefully it'll work for us on the upside, but certainly didn't give us a warning. Take a look at the next slide. This is another great indicator. It's employment growth. It's wage increases. If you just turn the slide, there you go. If you take a look at this normally, and let me just describe this to you, the wage increases generally bounce for the last 30 years between 2% and 4%. Take a look at that spike that we saw back in March. Now you would look at that and think, oh, wow, that's fantastic news. Look at, everybody's getting great wages. Well, what that's telling you, it's actually a bad story. What that's telling you is that the people that really suffered during the economic shutdown, the people that really lost their jobs either permanently or temporarily, were the lower paid workers, people that worked in restaurants, people that worked in hotels. So the fact that we lost their wages in the overall employment universe, that's what caused that spike. So you see the latest data point there, it actually came down. That's good. Normally you would look at that and say, oh boy, wages are the wage increases, they're not as strong as they were. That's good. What that tells us is that people are being rehired. So, when you see this, when you see the employment data get reported, when you see the wage data get reported, lower numbers are better numbers. We want to see that because that means people are getting rehired. That's a good number. If you turn the page to the next page, you'll take a look at one of the indicators, another indicator that we look at that did not work. So I'm showing you 3 in a row here that did not work. This is the yield curve. It's just the 10-year treasury minus the 2-year treasury. Normally 10-year treasuries yield more than 2, so you have a nice, what's called a positive yield curve. Every once in a while, when the Fed wants to slow the economy, they send short-term rates up, and the 2-year bond actually yields more than the 10-year. And that's that inverted yield curve area, the red area. Again, generally 12 to 18 months before a recession, we have that inverted yield curve. That tells us the Fed is trying to put the brakes on the economy. You'll see here, we actually touched 0 last August, and we were moving up. This was actually a very positive indicator. This is actually one of the indicators that's part of the LEI, the Leading Economic Index, because it is such a good indicator. This was forecasting good news. So again, the fact that it's positive tells us that we're probably in a pretty good environment for equities, that the Fed is trying to get the economy going. But again, just to show you how unprecedented the economic shutdown is, here's another indicator, another great indicator that just did not work at all. So if you turn to the next page, you'll see, just how severe this was. Take a look at 2020. A lot of us remember 1987. Take a look at all the past bear markets. We had the fastest and most severe downturn in the market, in the post-World War II era. It's just incredible. 33 days to have a bear market, which is incredible. So I know a lot of you felt that pain. A lot of you hopefully have benefited from the rebound. But just to put in perspective, a graphical perspective, at just how severe the economic shutdown was, I really thought this chart was great. Just to put in perspective, look at how long it took us to finally hit bottom back in 2000 after the technology debacle, and just in a few short weeks, we were clobbered. So if you take a look at the next page, you'll get a sense as to why we're positive on the market right now. What this does is it shows you periods. The gray periods are when investor confidence, consumer confidence, business confidence is negative, when it's declining, when we're worried. Look at what happens to the stock market. The yellow shaded areas are when consumer confidence, consumers are getting more encouraged, businesses are investing. The yellow periods there show you what happens in the market. So when we're in a late cycle, which even though we had a recession, technically we're in a brand new cycle, we still believe this is a late cycle. When we're in a late cycle, investor confidence, consumer confidence, and business confidence is critical to moving the stock market forward. So you'll see we fell off a cliff, and the latest numbers have actually been pretty good. Consumers are out spending. They're doing a very good job. The relief that we've gotten from the federal government to keep the economy moving, the extra money for the $600 a week for the unemployed benefits, that has done a great job in improving confidence. So we want to stay in the yellow area. That's our goal here with this chart. If you take a look at the next slide, you'll see some of our forecasts. I won't go into all of these numbers, but if I had been with you in February, our forecast for 2020 GDP growth was about 2.5%. You'll see it's down to 6.5%. If you take a look at that unemployment forecast, we believe we'll be at 9.3% by the end of the year. We believe we'll be at 6% by the end of next year. We were at 3.5% in February of this year. So another reason why we think we're going to be moving in the right direction. We'll be positive next year, but it's going to be very slow. We're probably going to, once we get through the rebound, we're probably going to go back to that 2 to 2.5% GDP growth, not a booming economy that you would normally see coming out of a recession. If you go to the next slide, you'll see some of the data that Mr. Conlon, my good friend John Conlon, is going to talk about, that goes from the 30,000 foot view that I just gave you down to more local. So John Conlon, let me hand it off to you.
Okay. As was mentioned, I happen to be the chief equity strategist. There's actually 5 senior people involved in the equity process or the investment process. 3 of us actually live here in Vermont. Although I'm a flatlander, I've lived down in Manchester and I've been here for about 25 years. The other 2 members are actually up in the Burlington area. So we're very familiar with Vermont and the economy of Vermont. In talking about the Vermont economy, I'm going to be stating some of the obvious, but also hopefully I'll be stating the not so obvious. I'm not going to try and duplicate information you've seen at presentations such as that Vermont economic update that's done once a year up there in Burlington, or the great demographic information that Professor Wolf puts together. If we take a look at that first chart, that's part of the obvious. It highlights really where Vermont's gross state product is coming from by industry. Obviously, tourism represents a big portion of that. In fact, you can see that the industries tied to tourism probably represent about 30%. Now, although each industry, such as food service or retail, aren't totally devoted to tourists, you can still get a visual picture of how important the tourism industry is to Vermont's economy. By the way, hospitality nationally employs about 11% of the workforce. So just in general, that type of industry is very important to the country as a whole. You can also see the diversification in regard to industries within Vermont and the base we can build on. There's areas such as healthcare, professional technical services, finance, insurance. These represent significant portions of the economy. And they have, at least going into the COVID-19 pandemic, have had good economic growth. And I'll get into that in a little bit. First, getting back to the tourism part of the economy. If you bring up chart 2, this kind of highlights one of the issues in regard to the impact of COVID-19. You'll see how the traffic statewide has really dropped off about 30%. So we're faced not only with that reduction in traffic, the closure of the border with Canada, shutdown of businesses. not just a ratcheting back, but as you know, as business people, business is actually being shut down for a couple of months. The end result has been an unemployment rate of almost 15% in April, and about 11% in May. So you can see somewhat of an improvement. I would expect June would show an improvement. Now, in contrast, last year, unemployment in May was 1.8%. Statewide, the numbers aren't all that different. 16 plus in April, almost 13% in May. So you can see the impact that the COVID-19 is having. Now, of over 6,600 small businesses in Chittenden County, and that's businesses that employ one person to 250 people. Over 20% right now are at risk of immediate failure. Typically, small businesses don't have a lot of staying power or cash reserves that they can work off of. Typically about 2 to 3 months. Now, about over 30% are at risk of near-term failure, and then about 47% at risk of longer-term failure. Now, this is an additive, so don't do the math and figure that, okay, longer term, 97% of the small businesses are going to go out. That's not the case at all. And the thing is, even though these are small businesses, they're very, very important. 90% have less than 100 employees, but they employ almost 84,000 people. The population of the Northwest in Vermont is close to 200,000 people. So you can see small business, but a large portion of the employment base. And this small business issue is not just a Vermont issue. It's a national issue. 48% of the workforce employed by what's defined as small business by the SBA, that's less than 500 employees. 48% of the workforce is employed by small businesses. Business employing less than 100 represent about 30% of the workforce. So if you consider the fact that 70% of our economy is driven by the consumer, and the consumer are these employees, you can see why reopening the economy has been so important. This isn't a political issue, shouldn't be a political issue. It's an economic issue, it's a health issue. That's why everyone is trying to achieve this delicate balance between new COVID cases and reopening business. It's essential that we get the economy back open. Good news is we will get through this. The economy is opening up. We've seen improvement in terms of the numbers. It's happening slowly. That's probably a good thing considering the situation we face with the coronavirus. And drug companies are making rapid progress in developing a vaccine. Normally, developing a vaccine would probably take about 4 years. So we're at the stage now where they're testing these vaccines, probably shooting for the beginning of 2021 to start finding a way getting out there. So you can see how quickly this has progressed in terms of developing the drugs. Now, I know I've focused my remarks on Chittenden County in Northwest Vermont, and it might not seem right for a guy living down in Manchester. I'd like to think that we're a little more important. But if you look at the next two charts, you can see the importance of Chittenden County in Northwest Vermont to Vermont. You're talking about a third of the state's population, and about 40% of the jobs are there. In addition, the prime working age population is in that area of Vermont. That's where the current opportunities are. Now, if we get back to industries that I highlighted before, things like healthcare, professional services, technical services, finance, that represents about 20% of Vermont's gross state product. That's very, very significant. not too far behind what the tourism industry represents. Prior to COVID-19, these industries were growing at an order of about 3 to 4%, and they were generating the largest increases in employment. Some of the areas such as retail and hospitality were actually seeing a bit of a decline in employment. So the potential there is real. And the thing is, we rank very well compared to the rest of New England, including Boston. If you go to the chart that's titled County and State Data, you can see that Burlington ranks very well in regard to certain demographics, relative even to Boston. In fact, it ranks third, with Boston in first, and we're right behind Portland, Maine. It ranks at the top in terms of education and employment, and has the highest labor participation rate. So granted, if you're young, Boston is probably a place you want to be. I have 2 kids that are in their late 20s, and that's where they are. But on the other hand, usually you want to come back home at some point. I know, for instance, my son does. So we've got a way for them to come back and grow the state of Vermont if we're committed to doing that. So I'll stop with my comments there.
Well, good afternoon. At the end of May, I was supposed to travel back to Europe for my high school reunion. My trip got canceled, of course, because of the pandemic, and I was really disappointed. I took the week off anyway and just stayed local. And since I couldn't travel, I decided to play this little game and pretend that I was actually overseas. And something really magical started to happen. I would go for a hike or a bike ride, or I would go watch the sunset over Lake Champlain. And a view that I might have seen 100 times before somehow became breathtaking again. I realized that I was looking at familiar sights through new and fresh eyes. And actually, Kathy, I forgot to ask you to get to my slide. Thank you. And that's when it dawned on me that there is a different way to look at our current situation. And I absolutely do not mean to diminish what we're all going through. This has been an exceedingly difficult time in so many different ways. Yet, I feel that there is a way to see opportunity in all of this. And what I want to talk to you about today is how to look at your current financial situation and begin to see an opportunity to take control, an opportunity to start feeling empowered again. Kathy, could you move to the next slide, please? First, let me set the stage. We have been experiencing a confluence of 3 different factors, each of them very significant. Of course, the pandemic and the associated recession, then all kinds of stock market volatility, and of course, the new legislation in the form of the Secure Act that was passed back in December, and then the CARES Act that came into being as a result of the pandemic in April. Now, each of these 3 things by itself would be reason enough to revisit your financial plan. But all three at once, that's some kind of a perfect storm of financial planning. So I would like to walk you through 5 strategies that for me stand out as areas to be focused on at this time. And as I go through them, I'm taking the liberty of including some of the photos from my staycation, just as a reminder to all of us that there is a different way to look at what's going on. Next slide, please. Cash flows look different for business owners and for many professionals alike. Many of our pre-retiree clients are asking, am I still on track? And this is exactly the time that we financial planners talk about when we say that everybody should have 3 to 6 months worth of living expenses saved in an emergency fund. So to the extent that you do, this is an okay time to tap into it. But, and I know this is not going to sound very popular, it is also a time to be revisiting our budgets. One of the big mistakes that I see happen is people taking out loans before they start cutting out discretionary spending. And yes, the CARES Act had provisions for coronavirus-related 401k plans. However, especially 401k plans are not a great way of covering for your current expenses because they get paid with after-tax money. So that is not an efficient way to do that. For those of you who are business owners, I hope that you got to take advantage of the PPP program. And one other thing that I want to put on people's radar is the mortgage forbearance program through the CARES Act. And frankly, this is probably the only time in our lifetime that we will ever have a chance to hit the pause button on our mortgage with basically few, if any, ramifications. Next slide, please. This is perhaps the most important slide of my deck. If you or your spouse lost a job as a result of the virus, make sure that you re-examine what other benefits you might have lost along with that job. And in many cases, this is going to include life insurance. Do not be underinsured. Let me stress that again. Do not be underinsured, especially during a time of pandemic. Look for a private policy. There has been a lot of change in the life insurance industry. The insurers are now trying to figure out their new actuarial tables. And frankly, it's a good idea to get the coverage now before it might get more expensive or even unavailable in some cases. And while the pandemic still poses that added risk. This is also a time to be updating our estate planning documents. And by that, I mean wills, trusts, powers of attorney, and advance directives. We should make sure that the stipulations we put in place are still relevant. For example, are the individuals that we named still alive? Do we still have a close relationship with them? Do we have the right beneficiaries on our retirement plans or on our other accounts? All good questions to be asking right now. On the healthcare side, now probably more than ever, the do not resuscitate, do not intubate directives are very important to have on file. And frankly, in some cases, people's thinking has actually changed relative to do not intubate as a result of the pandemic. So please revisit your risk protection plan. Next slide. This is a good time to consider a Roth conversion. A Roth conversion means taking funds from your traditional IRA and converting it to a Roth IRA. So you will pay ordinary income taxes on the amount that you convert, but then your Roth will not be subject to taxes ever again. So there's a lot of potential benefit here. And several factors lead me to this recommendation. First, many people have had a change in income and have a lower tax bracket this year. And also, asset levels are lower. So both of these things translate into paying less in taxes than you normally would for a Roth conversion. Now, on top of that, the Secure Act also eliminated something that was called the Stretch IRA, which was a very efficient way of being able to transfer money to the next generation. And without the Stretch IRA, Roth is a better way of passing assets on versus a traditional IRA. Could you move to the next slide, please? This one is for higher net worth individuals and families. Due to the decreased market values, this is a really great time to be gifting assets if you have a potential estate tax issue. Because by gifting now, you are not only taking the asset out of your estate, you're also taking out any future appreciation. So this helps you to eliminate or at least limit your estate taxes down the road. And I want to point out that this may be particularly relevant to business owners who are looking to transfer their business to the next generation. Now, I know we don't have a lot of time to get into this, so this is something I encourage you to speak with your advisor about. But this is a really good time to be looking at some advanced techniques, such as grantor retained annuity trusts, because we're in an environment with A, depressed market values, and B, lower interest rates. Next slide, please. Let's talk about your portfolio. This is definitely the right time to be rerunning your retirement projections. Hopefully your advisor is using something called Monte Carlo analysis, which means volatility, like we have been seeing, is already baked into your projections. But even still, you should be reviewing where you are, especially if you are getting closer to retirement. And on that front, I'll say a couple more words here. The recent legislation has introduced new rules relative to what's called RMDs, or required minimum distributions. So that's when you have to start taking money out of your traditional IRA or 401k plan to pay the tax on it. And that has moved from 70.5 to 70. Also, the RMD requirement for this year, for 2020, has actually been taken off the table. So another reason to be looking at your portfolio and rerunning where you are, making sure that the portfolio still meets your needs from a retirement standpoint. Then the next tip here is something John Trainer and I have actually been talking about lately, and that's the loss harvesting strategy. So you realize capital losses and they can be used to offset gains. And it's a really nice way to be able to sort of make lemonades out of lemons, if you will, in a down market. Also, an opportune time to be diversifying out of a long-standing concentrated position if you have those in your portfolio. And finally, turbulence, like we have seen in the markets, is an important time to be reassessing our risk tolerance. Maybe let me put it this way. There is a world of difference between filling out that risk tolerance questionnaire that you've probably seen a few times in your life and doing that in the comfort of your advisor's office, and really just trying to guess at how you might feel if there was a 30% drop in the market, and then actually experiencing what we saw earlier in the year. So really important time to be relooking at your portfolio with a new perspective on your risk tolerance. Next slide, please. I have a few more tips for special circumstances. The first one is, if you own your own employer stock in your employer-sponsored retirement plan, and that stock has gone down in value, this might be a good time to sell that stock and then buy it back, and that way lower the cost basis in that particular stock. It sounds counterintuitive. However, the reason is that it might give you a leg up if you're ever using something called net unrealized appreciation strategy down the road. And this is something you should, again, talk to your advisor about if you fall into this category, because this will allow you to save even more on taxes down the road. So take advantage of the situation now for future benefit. My next bullet point here is, if for those who spend a portion of their year in Vermont but are claiming residency elsewhere, you need to pay extra attention this year. And I'm sure you probably are already. You're all on top of your days in Vermont versus days elsewhere. But due to COVID-19 restrictions, you may be finding yourself spending more time in Vermont. So you want to be careful about establishing an unwanted tax residence. And finally, if you are getting close to age 62, which is when you first qualify for Social Security, you may want to work with your advisor to reassess when is the best time to start taking Social Security, because that might have changed due to the fact that many people's incomes have changed recently. And if you could move to the last slide, please, Kathy. Thank you. This brings me to the end of my list of financial planning strategies. Let me quickly recap what we talked about: addressing cash flow issues, ensuring risk protection, which is perhaps the most important, considering a Roth conversion and lifetime gifts, and then also revisiting and realigning your portfolio. And in my parting words, I really want to encourage all of you to take this opportunity to readjust your situation, to fine-tune your financial plan, given everything that's going on, because that way you can hopefully start to feel like you're in control again and you feel like you have truly put your financial house in order again. So with that, I will turn it back to you, Kathy.
Thanks, Susanna. I'm going to stop sharing my screen so we can see all of our panelists again. And I know that we have at least one question. So the first question is, do you have projections of how our local economy will be impacted if a vaccine is not developed by early 2021 and we experience a second wave this winter, resulting in another large period of quarantine?
Well, let me start there, and I'll let John Conlon weigh in. Well, you know, that is probably the $84 question, the $8,400 question right now. I mean, our hope certainly is that we have a virus discovered this fall, and it will take several months to go into production. So hopefully, then we'll have usable dosages early next year. That's our hope. It's from what, you know, I'm not an expert in the area, but it looks like we're probably looking at next year before, you know, a virus, you know, a vaccine can get through testing. All right, so let's assume, you know, best case scenario, we get something done this fall. Okay, base case is we're probably looking at early next year. Either way, again, you remember those charts that I showed on consumer and investor confidence? Well, I guarantee you that the headlines in all of our local papers, as soon as the fall shows up, is that normally you see a second wave, and that's just logical. We've seen that with prior flu seasons. So one of our concerns is, even without the discovery or the development of a vaccine, we're going to have headlines out there that are going to slow consumer spending. They're going to slow investor sentiment, which will probably cause the economy to slow down a little bit. So even without, you know, a tremendous jump in infections in the fall, we're going to be preparing for it, and that's one of the reasons why we have muted expectations going forward. If it takes, you know, until next year to even discover or develop a vaccine, well, then it's just going to elongate out the recovery. I didn't have on the chart, but our expectation for GDP in 2021 is only 5%. Now, again, coming out of this huge decline, we should see economic growth at 10% next year. So 5% growth, even though it's nice, you know, it's still not strong enough to really propel the economy. And then we go back into that sort of, you know, 2% growth after that. So, you know, if it takes too long to discover a virus, all that's going to do is further dampen the economy. it's going to further dampen investor expectations and probably mute, maybe not push the economy back into recession, but certainly slow the recovery. Yeah, John, did you have any more thoughts along those lines?
Well, in regard to Vermont specifically, I don't have any projections, but again, I'm going to be Captain Obvious here. If we have to go through some type of, let's say, second economic shutdown in Vermont, it is going to be pretty devastating. I mean, I went through some of the statistics of how we've been impacted so far. And if you consider that we rely a lot on the hospitality industry, and that's an industry that is most heavily impacted, and also retail, most heavily impacted by social distancing, you can see what would happen if we have to take some drastic measures to try and contain things. You people that operate restaurants, you know what you need in terms of capacity to make money. It's not a high margin business. You need a lot of people in there, a lot of capacity. You can't get by on 25, 30, or even 50%. And you need the turnover, you need the traffic. Retail is also not a high margin business. Hotels, you need the occupancy. So if that's not there, and I showed you the drop off in traffic, where it went down 30%, still the same seasonal patterns or patterns month to month, but down 30%. It has an impact. I will offer some anecdotal information from Manchester. Manchester has what the locals call the horse show every summer. It's known as the Summer Festival formally. And it is a major, major draw to people that are horse people. You can't find a hotel room, an inn room in Manchester during the summer. That was canceled this summer. So although we see a lot of tourists about town, we lost a significant amount of revenue. So just imagine if ski season is heavily impacted because people aren't allowed into the state or have to self-quarantine. It's going to be tough. So I don't have a number, but it's not going to be a pretty one.
Thank you, John. Yeah, we just all up here saw the news last week that the People's United Bank Marathon was canceled, and that is a very similar event for Northwest Vermont as the horse show is to Manchester. As a reminder for our attendees, there's the Q&A function at the bottom of your screen. So if you have questions, please use that. And we have a couple more questions. This one says, I am on the board of a nonprofit organization whose single revenue generating event for the year was canceled due to COVID. We received a PPP loan and can survive until next year's event, if we can hold it. Are there any lessons to be learned from previous times of economic difficulty? Are there a certain amount of nonprofits simply lost during difficult times?
Yeah, I have been doing, I don't know how many virtual challenges. I'm a rower, and I just got the news this morning that the Head of the Charles was canceled, which, is a huge event for Boston. But what they're doing is they're doing a virtual row. And I know I've spoken to a few of, we work with a lot of nonprofits, and this is a big issue for us. We're trying to help them. And some of them have actually found two things. When they do the virtual challenges, they're amazed at how generous people are. And then a lot of them have said, you know what, when we go back to, normal times, we're still going to have our big gala. They'll have the big horse show down in Manchester. But they've realized we've got another whole source of revenue here that we never knew. And a lot of them have said, even when we get back to normal, we're going to maintain some of these virtual challenges. So again, it's certainly tough right now, but a few of them have said we could actually emerge from this a little stronger because we realized we've just tapped into a new network that we never knew we had. So, in every challenge, there's an opportunity. And some of the nonprofits that we're working with right now have actually said, you know, a year or two from now, we're going to be tough. Right now, you know, it is tough because not only is funding down from their traditional sources, but need is up. I know, you know, at People's Bank, we have our own community foundation, and you know, we're actually increasing the amount of giving that we're doing just to support a lot of the local charities that we know are struggling. So it's a big issue. I don't know. I mean, Susanna, you work with a lot of people that are donating that would be the donors to some of these. What have you heard?
Yeah, you know, basically the situation is as follows. For those people who have been able to retain their incomes and did not get impacted too harshly by the pandemic from the standpoint of what they were able to take in before, similar to what they're able to take in now. They're very generous and they continue to support the organizations that are important to them. Of course, when you have to start making tough decisions and you look at other things that you should be doing with your money for your family, for your legacy, you know, for kind of ongoing charitable commitments that you've had, then that's where the impact is. So that's what I have seen.
I sit on the board of a number of nonprofits, the finance committees for them, and the cancellation events hit hard because usually that's a significant contributor to the fundraising. What's happened is a number of them have come up with unique ways of continuing the normal event. One hospital I'm associated with, they have a summer gala. They're setting that up as a virtual event. There's a golf tournament I normally play in, and that's been canceled. But what they're doing is they're asking the usual participants to sign up, almost as kind of like you'd see with Walk, you know, a mile. So you donate based on the number of rounds or holes of golf you play. So there are some creative ways of trying to at least continue the fundraising, but it definitely has a significant impact. The other thing I'd mention, because this is usually a topic of conversation on the boards I sit on, and that is managing your spending. And managing the spending to the extent that you need to maintain that endowment or foundation. A number of boards are almost embarrassed by the amount of money they have and feel guilty about holding on to it. It's things like this that make it clear that you need that, so that you shouldn't feel embarrassed, you shouldn't feel a need to spend it down. You should continue to maintain the discipline that you've exhibited, so that when you go through times like this, might not be the COVID, could be an economic downturn, you've got that foundation, that base you can live off of and survive for when times get better.
Great, thank you. We have about 10 minutes left and there's 3 really good questions. So I want to try to hurry through. The first one is, with interest rates near zero and increasing credit risk with companies and governments to the state of the global economy, where do you see opportunities to enhance yield in fixed income?
John, do you want to take that?
This is where I wish Teresa was here. She's our fixed income person. As I'm an equity person, I would, on the equity side, you can find good dividend paying stocks where the dividends are rather secure. Even in some areas where the industry is having a tough time. Banks, for instance, although there are some banks that have had to cut their dividends, in general, the banks are well qualified and they're good dividend payers, even within the energy industry. and just within the S&P in general. You're going to have cases where dividends need to be cut, but in general, the dividends seem to be rather secure, and they offer a very good yield relative to fixed income.
Yep. And then just if Carissa McDonough, who heads fixed income for us, who lives up in Waterbury, if she were on the line, the one thing that she's really focused on right now is with interest rates so low, a lot of people are tempted to take on a little bit too much risk, maybe buy some low quality bonds or different things. She really is emphasizing the fact that, you know what, listen to what John Conlon was saying, take a look at some alternative sources. Don't really go down the credit quality scale right now. This is not the time to do it. You're not being paid for that risk. So she's really focused on the quality side of the fixed income portfolio.
Great, thank you. The next question is, Zuzana talked a little bit about eliminating costs before taking out loans. What are some other risk mitigation strategies in small business financial forecasting? Is that something someone can answer?
Can you repeat that question, Kathy?
Sure. So you were talking about sort of eliminating costs before you took on more debt, and they're wondering if there's additional risk mitigation strategies that a small business can use as they're forecasting.
Yeah, I think there's some parallels between sort of our individual financial planning versus financial planning on the business side. And kind of approaching it with that mindset. Obviously, the first step is you have to figure out where you can cut and where it's not going to hurt as much. And that was, that's where I was talking about discretionary spending on the individual side, and what that might look like for a small business. It depends on exactly what business you're in, but I've seen some businesses cut back on their marketing expenses. There's actually opportunities with some businesses that I've seen in terms of saving on some of the costs they would have considered more fixed, like office space and kind of the infrastructure that's available for employees, because now a lot of people are able to work from home in those industries where that's possible. So looking at that and being very thoughtful about, from a strategic standpoint, obviously you can't cut where you're not going to be able to recover from it. But if there are short-term opportunities for you to stave off some of these expansion plans, or to be able to not spend on things that in the long term won't hurt you as much. It's kind of this short period of pain that we all have to endure, with the hope that we will get back to normal. So my suggestion would be, look at the long term, where do you want your business to be in, say, 2 years' time, and try and be very thoughtful about where you take out, so that it doesn't impact your long-term opportunity to be back in business and be successful.
Thank you, Susanna. The last question that we have is, what are your thoughts regarding the end of the $600 weekly unemployment stipend that's scheduled to end later this month? The comment is, this has made life bearable for many Vermonters, many people nationwide. Should Washington re-up this funding? How much more national debt can we deal with going forward? A bunch of questions buried in there.
That's probably a good question for all three of us. I'll start, and then Zuzana and John can join in. But number one, I talked about that consumer confidence. One of the reasons why consumers are able to spend and they haven't hunkered down tremendously is because of that. The fact that there is that support. There was a great statistic that 68% of the people that have lost their job during this this crisis are actually making more money on unemployment than they were making in their former job. So one of the things that a few of the governors have talked about, I know the governor here in Connecticut and the governor in Ohio have said, you know what? If we just pull the plug on people, we're going to have a lot of people with some big problems. And what I actually was pretty impressed with their thinking. They've said, why don't we have a phased in, a decline in that so that you can go back to your job, right? You're going to be making probably a little less money at your job, but then we still keep that stipend coming out, and maybe it starts to decrease over the next several months. But I think having some kind of a continuation of the plan, or some kind of a program that allows people to go back to their job but doesn't pull the rug out from under them, that's really what I think is being debated down in Washington. But boy, to keep the economy going, I really think we need to do something there. I know it's adding to the debt, but we're really trying to keep our neighbors and our families intact right now. I don't know, Zuzana or John, do you have anything?
Yeah, I mean, one of the things, obviously, people know that's being debated is to make this available only for those who actually were getting more than they would have been with the extra $600. So maybe that evens out the playing field a little bit. And I suppose from that standpoint, it's going to the places where it matters the most, because those are the people who, without that extra money, are not going to be able to sustain what they had before, whether, that's their mortgages, that's their groceries, that's paying for their kids' preschool, whatever that might be. And so that might be an option that perhaps is workable and kind of an in-between solution. And I completely agree with John that pulling it out altogether, I think would be a huge hit and quite a shock to the economy, because then not only the consumer confidence, but frankly, consumer spending. And then I think we would get into a situation where, and depending on where people are at with mortgage issues, for those who are renting, not being able to continue to keep their homes, and that becomes a real social issue at that point. That's beyond an economic issue.
I would agree with the comments that made about the need to continue this in some form, some level. I mean, I went through the statistics in regard to small businesses nationwide and how much of the workforce is employed. And these businesses, not because of a lack of success or management, but just because of their nature, they don't have the access to financing capital markets that larger businesses do. So their employment base is going to need continued help as long as we're having some type of restriction in terms of the economy. Different areas, not just states, but different localities are going to be opening up at different paces or shutting down. We're in a unique situation. You can think of it as being we're at wartime. And in those times, you've got to do things very differently than you would in a normal economy.
Well, thank you to all of you. That is the end of our time together. We have been recording this webinar, and we will post it as soon as it's available for anybody that wants to rewatch all of it or a portion. I want to be sure to thank our panelists, John Trainer, John Conlin, and Zuzana Brochu from People's United Bank. We appreciate the time and the expertise you shared with us this afternoon. And thank you to all of our attendees. One reminder for those that are interested, we are hosting another webinar tomorrow focused on diversity, equity, and inclusion. So if you're interested in that, please visit our website, which is vermont.org/chamber. We'd love to have you attend to that one as well. And I wish everybody a good afternoon. Thank you all.
Great.
Thank you for having us. It was a pleasure.
Bye-bye.
Bye-bye.
Take care.